So is there a tax bomb that is coming that is going to attack the global economy and specifically you here in the United States? Well, I'm here to tell you that there's new proposed legislation that's out there that people are looking at as a good thing, but could be a challenge. Let's take a look. So listen, for years, the government has actually been decreasing tax rates. And the reason for it is because there were more people in the workforce to be able to tax, quite frankly. However, when you look at debt to GDP, right, when you look at the state of our economy currently, the writing is on the wall that the tax bomb could be coming. And there's new proposed legislation that's out there that they are making you think is a really, really good thing, but could be hitting you with a future tax bomb. Let's take a look. So imagine being in a partnership with somebody where you're 50-50 partners, but then when it comes time for you to take distribution from the asset that you were partnered with, they have the ability at any time without your blessing to renegotiate the terms. Welcome to 401k. Let's take a deeper look. Whenever the government changes their tax legislation, it's important to read between the lines in order to see the economic behavior that they are incentivizing. Seeing where they encourage people to put their money helps you to know what they're planning for the future. In 1974, 401k was introduced to be a supplement to pension plans. Well, we all know that pensions are basically non-existent any longer, and now the 401k is the icing and the cake. Right? And the federal government wants you to believe, quite frankly, that 401k is really the only means for saving for your retirement. But what have they done? They've shifted the risk onto you, not only from an investment risk perspective, but also from a future taxation standpoint. Remember, monies that go into 401k plans traditionally go in prior to taxation, grow tax deferred, but then are ultimately fully taxable when taking distributions. Now, if you keep money longer in those accounts, you would believe that I'm deferring taxation for a longer period of time. Really, really good thing. But if tax reform were to take place, or if I have larger distributions needed to take, guess what they can do? They can tax me more, and if tax rates rise, I'm actually losing buying power. The first thing that I want to do is I want to congratulate you on saving money, right? You got to pay yourself first. And if you're saving, even if it's towards a 401k, and I'm not going to say even, but towards a 401k, congratulations. However, there are things that you need to be aware of in this new proposed legislation. With the new proposed legislation, 401k elective deferral contributions are going from $19,500 up to $20,500, right? And there's also additional catch-up contribution that's available. But for those looking to max out their 401k in 2022 as employees, you can now contribute $20,500, an increase of $1,000 from 2022. What that doesn't necessarily say is that there's an obligation for employers to increase matching contribution on you. Remember, it's not about you, it's about corporate, right? So where are the incentives for the corporations to increase matching contributions? They haven't been put in this proposed legislation, shifting the risk onto you, which is part A of the potential tax bomb. The ultimate question is taxes now or taxes later? Most people are of the mindset that I want to pay taxes later, I want to keep my money right now. And in addition to increasing 401k contributions for employee elective deferrals, what the proposed legislation is also saying is that they can now defer required minimum distributions, aka the government has a lien on my money, out to 72 from age 70 and a half. And by the way, that could go out as far as 75 by the time 2030 rolls around. Now, most people would say to themselves, that's a good thing, but let's take a closer look. The older you are, the shorter your life expectancy you have, and the greater the required minimum distribution becomes. Thus, the policy is encouraging people to take out distributions in higher tax brackets. If higher tax brackets are not the case, let's say the tax brackets even just remain where they are, guess what I'm doing? I'm taking out larger distributions. That's more money that the government can tax. And when I have more taxable income as a result of just getting older, what can I do? I can automatically thrust myself into a higher tax bracket. Therefore, it's a hidden revenue generator. The government is going to need that principal and that money in the future to fund other programs. You need to be aware of this. Hey, but why stop? Let's not just increase the elective deferral contribution, let's increase the catch-up contribution, and let's make you think that that catch-up and stuffing more money into that tax-deferred vehicle is going to be a great thing for you. Look, again, you're saving money. Congratulations, that's fabulous. But if I'm continuously pressing the envelope and putting money into a spot where I am not aware that I'm actually going to be losing buying power in the future because I'm creating more tax liability for myself in the future, is that a good thing or a bad thing? For contributors age 50 plus, catch-up contributions allow people who have not maxed out their previous 401ks to put more money into them. This increase in catch-up maximum encourages people to put money into tax-deferred accounts as opposed to tax-free accounts. If the government were to increase taxes in the near future, this would help increase taxable revenue. This does pertain to Roth as well. Roth operates a little bit differently. It's on a tax-free basis. However, the increase in Roth contribution means the increase in income taxation that you are going to do right now to put into a otherwise tax-deferred account. So it's beneficial to the government on the front side, and it's massively beneficial to the government on the back side. Are there ways that we can plan and prepare around this? You bet. And the older that we get, the proposed legislation increases the catch-up contribution even larger. 62 plus, the catch-up contribution goes to $10,000. But the question that you have to ask yourself is that additional $10,000 really going to move the needle in terms of income distribution, especially when you take a look at what's happening in the markets right now with volatility and also buying power on those dollars? Perhaps there are other ways that I could save that $10,000 to actually benefit me even greater in the future. I'm not a CPA, and I'm also not here to tell you that 401k is the devil. It's not, right? There are pros and there are cons to 401k. Pros include tax-deferred contributions, matching contributions, and those contributions do lower your income tax bracket federally every time that you make a contribution to that. And so if you can afford it, and you absolutely need the tax deduction, 401k can have a number of different benefits for you. But you have to be aware of what the cons are as well. They are not flexible. The investment choices in there are chosen by somebody other than yourself. The fees can be high. You have to be aware of what internal expense ratios look like in the 401ks, and is the advisor getting paid? We don't know. Also, income taxes could be reformed in the future. And if this legislation goes through as well, you could find yourself with mandatory distributions of larger dollar amounts that could thrust you into higher tax brackets. So we have to weigh the pros and cons of those, and that's where planning comes into place. There's so many different options for planning for retirement. 401k doesn't have to be the only option, even though they would have you think that it is. Guess what? It's not. Click the link below. A member of my team will have a conversation with you about planning for an appropriate retirement. Benchmark that with your goals, understand your tax exposures, but also understand your overall allocation of risk and what your plan currently looks like. Let's look under the hood and see if that plan is best serving you. Folks, I think the global economy is going to be okay if you keep watching our videos. And so if you like the content that you saw today, go ahead and smash that like button down below. We're working really, really hard to bring out new content each and every single week. And if you like that content, go ahead and hit that subscribe button and take a look at this next video that's coming up.